Hello, welcome to this video. We're going to be talking about which direction you should be trading in. When you switch on your computer, first thing you have to determine is which direction I'm going to trade. Now, you could flip a coin and give yourself a 50 to 50% chance, or you could put probability in your favour and stick with the current trend. This is your best policy against risk. If you think you can pick tops and picking bottoms of trends, believing that you actually caught the true reversal of the main trend, I encourage you to look at the trend and find out how many signs of reversal it gave out, and just still continued on with momentum. This occurs all the time. The best policy, like you can see here, engulfing candles, more engulfing candles, but the trend keeps going down. So this would be called picking bottoms, because you believe that it's reached a true bottom. Let's just say, for instance, you had a support level in here. They probably would be way back somewhere, and you've seen this reversal. You would believe that's it. That's the end of the trend, possibly. And if you put in a buy trade there, man, this trade's going to go on forever and ever, and you're going to make thousands and thousands of dollars. Now, as you can see, wasn't the case, like it happens all the time. The momentum of the trend is very strong, and it continued on down. Now, this is a daily chart, and look at the one here. These candles, signs of reversal. Although it did go up quite a fair amount, price came crashing back down. If you decided buy here and hold it in the hopes it was going to reach up here, well, you see what happens. The market gives these little signals all the time. Nice little bounce off the Bollinger Bands there. You probably could have entered on that candle if you were trading at a high risk. You would have got stopped out by this candle, of course. You might have bought back in a very large stop loss, because that's a dramatic spike through the Bollinger Band. You would consider that as a buy in some cases. Only worked short term, to be honest, before the price came back down. So momentum is very important. So yeah, stick with the trend. That's a key factor here. Yes, counter trends do work, and they can be profitable, especially when you're short in markets. When they're overpriced, you can make a lot of money very quickly, but they can come at a heavy cost if you get caught in a strong trend. Believe me, I wiped out 60% of my account one time, thinking the market can't possibly keep going. Well, let me tell you, the market will do whatever it wants, and there's no such thing as a true top or true bottom. So in your best interests, stick with the momentum, and if in doubt, stay out. Okay, we always, I think it's in our nature to believe that we have caught the top or bottom of a trend. Everybody gets a little feeling inside them, you know, like this is on this euro US dollar today. This will probably close at an engulfing bullish candle, and a lot of people are going to want to buy, and it probably will come up a little bit, because as you can see, it is oversold a little bit here. But although it's oversold, it can still continue for hundreds of pips. Let's take, for instance, when this came into oversold territory, roughly where it is just now. It gave a little candle formation here, right, close to the Bollinger Band, never touched it. You probably should have entered here if you had a bullish emphasis on your trading. But since that point, up until when it came out of the oversold territory, you see how far the market actually came down. I'll just measure it from here to roughly here. That's 150 pips. 150 pips in oversold territory. The stochastic was coming up, but the market still goes down. Okay, so there's probably about 300 extra pips here since it became into oversold territory. Okay, so it doesn't always mean because it's in the oversold territory that it's going to change. You need it just means that it's a probable area for it reversing, but you do need other factors in place to make a trend reverse. So the key factor is to always stick to the trend. Okay, so we're in a short market just now on the Euro US dollar daily, so you only trade short on the Euro US dollar on smaller time frames. Now when you're doing your analysis, if you're trading on a 1 hour chart, look at the trends on the 4 hour chart to base your trading on, or even better, I always go off the daily trends when I'm trading on the 1 hour chart. If you're trading on a 4 hour, you can go utilize the weekly charts for your analysis. There's a few things you can do here. Looking at the Bollinger Band range, looking out for Bollinger Band squeezes where the market ranges through times. These can be key factors. I mean, look at this little key here. You know, the Bollinger Band just points it out so clearly that there's a very, very key support level in here. Just draw a little line in roughly there. That's a little range there, and then of course the price is still coming down on the tops here. So the market's been ranging, high volatility through here, big swings, but it's slowing down, bouncing between this range. Bollinger Band starts coming into a little squeeze, which means it's coming into a little range market type. As we can see, this trend line held up after a couple little tests of it. Price came crashing back down. Now the probability of this price coming down, first support level would be this Bollinger Band. Second support area would be the support line defined by these levels here. Now this level isn't approximate. It could vary within pips, it could crash right through. So a few other things you can do. You can utilize your support and resistance lines, find out where it's trading when it broke through certain support or resistance. Like, let's just say this level here, when it breaks through, you know you're short until you hit, let's just say, this level. Okay, because that's the next level of support. You can always go back, see where the support or resistance lines are, but this was the next one I came across. Next one, that's a key one there, because that was pretty much a 1-2, tested it 3 times there. So if and when it breaks through this price, you'd be looking to go short, or if it breaks through this trend line that I've drawn in, you'll definitely be looking to go long. Okay, so this little trend line here, if the price comes back through, or long, the price breaks through there, you're short. Now, these are not trade recommendations, these are just little ideas on how you should utilize your trend direction. A trading style has to suit the type of trader that you are, so whatever I say won't fit everybody. So now you can see here, United States dollar, Japanese yen chart. The price was long all the way. Now you can see you could have started a trend line from here. It would have taken a while to get up here, but then you've got 2 points to draw it from, and then when you got a little signal here, you've seen the price coming back down. Definitely on this candle, this big red bearish candle right here, you definitely would have been short, because this was right through the trend line. Dramatic move down, came below this dragonfly doji right there, and yeah, it was definitely a short market. Now if you find a place to get in there on a smaller time frame, great, because it would have paid off. Now what the market done after that, so after it came down a little bit, might have hit a Fibonacci level. We'll see about that. Yes, bounced off the 50%. There you go. Now people would have the reason this went sideways is because of this move, what I just pointed out with the Fibonacci there, because it came down to the 50%. A lot of people would have started taking their profits from this short trade after placing a short on this trend line. Okay, so after this big move up, everybody's in. As soon as people see the market's tanking it, they'll exit their trades. Market starts coming down, people start shorting the market, brings the market down even more, and then when it hits about the 50, some people start coming out of the market. Okay, and then it hits that indecision mode where it just ranges. Now at the same time, getting this nice little triangle here, descending triangle, and you can see this Bollinger Band squeeze here as well. It tightens up to the lowest it can go, where both Bollinger Bands, the top and the bottom, go absolutely flat. That means the volatility in the market is at its lowest point, and at any point you can expect a breakout in volatility, because that's the cyclical nature of the market, going from low volatility to high volatility to low volatility again, so on and so forth. So there's a good little indication on a nice breakout in volatility. Now this could happen right here, right now, because of this triangle. We can see this nice little breakthrough. Through this period you would have been range trading. As soon as it breaks out this little trend line here, after this day right there, that's it, you're in a long market. You might have missed this move, but when it retraces and comes back down, I bet you excuse me, I'll stop this from moving. On the hourly chart, after the price came through, came back down, tested the support of that long-term trend line that I drew on the daily chart. Didn't really throw up a very decisive candle formation, but you could just enter on the trend line bounce anyway, or you could enter on a trend line break from this A to this C, A, B, C, D. As soon as it broke through this little trend line, there you go, on this hourly, place a trade, and you'd be looking at 45 pip stop before the price continued on up away. Okay, so from when the price broke through here, you knew you were going to be long trading, not short, long only. Okay, so whatever candles you seen up here, you would have got, there's an engulfing bearish candle with a nice spike up after it. That was probably a news event there. Excuse me. Another engulfing bearish, fair enough, the price started going back up. Yeah, nice, well, a little spike doji there, and then a bearish engulfing, a very dramatic one at that as well. So throughout this period, you know you're not going to be short in the market, you know you're going to be long, because that was defined by the higher time frame descending triangle breakout. Okay, so you always want to be clear in your direction. Don't try and jump about. Although this one actually paid off short term, over the long term, look what wins the best. Okay, so that short term moves happen all the time, but you want to try and capture the longer term moves. So you always go into the higher time frames, do your analysis and figure out where the market's going at the time. Okay, do your chart patterns, look at the Bollinger Band squeezes and ranges. A lot of the time it will range from one end of the Bollinger Band to the other. As you can see here, went up. Where was the target after this? The other Bollinger Band. Came down, kissed off it nicely, engulfing bullish candle right there. then another one, and then the price just went absolutely ballistic after that. Now the reason the price went ballistic is because what we got here, Bollinger Band squeeze, very powerful tool, very powerful. You can see another one here. This is it. Market's at its lowest volatility. Why is it at its lowest volatility? Because it's been trading sideways for all these days, just sideways, sideways, sideways. No clear decision on where it's going to go. Something has to pop sometime. So in this case, would you have traded that? Who knows? You know, each to their own. You might have gone short here, you might have gone long there, whatever. But nice little breakout. Great amount of pips there. In this case, it only went about 2 to 3 times the height. Same distance as the range pretty much, but sometimes they can just continue on and on and on. Alright. Just move on to another chart. Great British Pound US Dollar here. This is a weekly chart. Now this went sideways for ages. That was boring. I like to see the Great British Pound US Dollar actually trading places, you know. But after the recession here, made a little correction, and yeah, it started going sideways, and there was some good opportunities to sell here. Got nice. As soon as you had this point and had this point, we could draw in this trend line. As soon as we got a little price interaction here, that was a great opportunity there. Price was profit target was down at the Bollinger Bands there. Of course, went a little bit further. Now price is just going on and on, but it's thrown up this another triangle here, and then things changed from a range market to a long market when the price broke through this trend line. Now we would have been short if we went here, but in this instance I've gone to the daily chart and thrown up another couple of trend lines for you. If you were doing your daily analysis, you could be throwing up daily trend lines, working with the daily trends. So once you got an A point, a B and a C, you draw your trend lines, and then you look for your D's. Okay, so in this case price continued on for a few more days. Looking at a 1 hour time frame, there would have been nice buying opportunities. And when do you start shorting the market? You got it when the price breaks through that trend line. Now it's a short market. Okay, so now you draw that trend line in. Okay, you got your A point. You can only draw your trend line in once you've got an A, a B and a C. So I'll just do that from the start again. So you had your trend line there. What happened with this trend line was price started going a bit faster. So from this A to that C, price broke through there. Usual price after that, taken on this trend line. But after this broke through here, it was a short market. Okay, or we're definitely not long anyway. This much we know. Once you've got an A with a price move down, that will be your B. With a retrace, that's your C formation, with signs of going back down. Now it could continue up, nobody knows, but if you've got an A and a B, you're looking for the D. So you'll be looking to short the market on your lower time frames. This is daily. Go to your 1 hour chart. You would have found selling opportunities in here somewhere. You would have made money here, you would have lost money coming up here. That's the way it works, and that's why we cut our losses when the market goes against us and let your profits run when the market goes in our direction. So, and then when does this change? When the price breaks through the trend line again. So after it breaks through this short trend line, it's now a long market again, vice versa. Alright, so these are all instances that occurred all the time, and you can put this into your trading, but you got to find out what fits your style. So once again, long market, A, B, C, looking for the D, long all this way. Well, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days or so before the price broke through. Nice little spike here through the trend line, probably would have been long again for a day. Might have got a couple of quick short trades in there, but price was signified by this it's not the best engulfing candle in the world, but it's good enough to stop making long trades and start having a short emphasis in my mind. So, and then look what happens through time. Market starts going down. What you could have said was after this long-term A, B, C, D move, on this C, if the price breaks through there, then it's definitely a short market. So, you know, utilizing your ABCs. Okay, so you might have been long here, but staying out of the market as the price corrects. Okay, it's a short market right now on the daily chart. We'll be looking for selling opportunities, but right now, as it says, is a time to be cautious, because we're at the Bollinger Band range. Now it could continue on downwards, nobody knows, but probability right now this is going to make a little retracement up the way, so I'm going to tend to stay out of the market for a while, especially while it's oversold. I'm not going to take long trades until I get some confirmation out of this trend line break with a retrace back down, and then I'll start thinking about buying. Okay, so that's a pound. Now we were talking about ABCs, your ABCDs, the way the market moves. Now this is how it moves. This is a little indicator that most of your MT4 platforms should have on them. It's called a zigzag. You can find it in your navigator panel and find it right here, zigzag. This is it clearly illustrates the ABCDs of the move. Now it does lag a little bit. It won't always. You may have 4 or 5 candles where it doesn't have a line, so you might need to wait. A lot of the time you can figure out what they're mostly based on is a trend break. Okay, so after this point, this zigzag would have came up. Okay, but it's a nice way to illustrate which way the market's going at the time. Okay, so A, B, C, D. This is lower than this one. It's trending. Lower lows with retracements. Lower lows with that retracement. Lower highs. Lower lows. Okay, so within this range of here, you're looking to short the market. So this price could come anywhere up to here, even touch the line before going back down. Okay, if the price comes above this, then things are probably invalid and I wouldn't consider shorting the market anymore, and it's more likely going to turn into a longer market for the time. Okay, this happens all the time. You know, price goes up, ba ba ba, price goes down, ba ba ba. You know, so you gotta be agile, be in and out, just look for these things. So A, B, C, you got your C, and you're looking to short after these. Okay, so keep following there, draw your trend lines in. Okay, see how that works out. Selling there, not so much of a great opportunity there. The candlesticks don't really define a clear opportunity in there. This one could have been traded. I rushed through the trend line and I'll crash back through the trend line the next day after. So as long as the daily close came back through, this is just a test of its resistance at this time. If the price closed back below it, then yeah, you would short the market. So back in the short trades, expect this to come down, take your profit level at the lowest low, okay, or your Fibonacci extensions, but we'll talk about that in another video. Other things you can do is utilize moving averages as your trend direction. In this case we've got a 21 exponential and a 50 exponential. Now that was on a weekly chart. On a daily chart, when the 21's below the 50, you only short the market. Okay, so these trend lines just show basic trend momentum. Now, the thing with your moving averages is they are lagging indicators, so they work on, the 20 works on the last 21 candles, and the 50 works on the average of the last 50 candles. Now, a lot of the time, you know, the longer term, the slower the moving average, you can be missing out on a lot of trades. What I wouldn't do is use this cross as a time to buy, because the price would be already up here. As I'll zoom in first actually. So get my crosshairs up. So the close would have been through here on this candle. Now on that candle there, price was way up there. Now you'd be looking at a 370 pip stop there. So moving average crosses aren't particularly my favourite way of trading. I know a lot of people do utilise them in smaller time frames, but when you get to longer time frames, the price has just gone too far. What they do signify is the trend has changed somewhere in the last 20 to 50 days here, back there. Something start to change, okay? And when the red line is above the blue, you should be considering buying the market, and when the red line is below the blue, consider shorting the market, vice versa. As you can see, good thing about moving averages, as well as Bollinger Bands, that they clearly show ranging markets. When things start getting all chopped up here, sideways, not going anywhere, no clear direction, the moving averages are just getting tied in with each other like tying your shoelaces and double knots and stuff, it's showing a trend, ranging market, which is great, you know. So find out the range, draw on your support. Okay, so based on this high, this little bully candle that went through, this little almost a dark cloud cover there, this low signified by this lovely little spike that it threw up there, and then come along, nice little doji, engulfing candle, you know, that's great. This candle, laid out the range. Okay, now what you can expect, the price comes down here, can go up to there. In this case it didn't go all the way up to the top, not quite yet, but it was another great opportunity to get back in at a very low stop loss. You would have entered on this doji, very probable, and target area other side of the range, so buy low, sell high. Now you would expect this price to come back down here. Now one of these days it's going to happen, there's going to be a range breakout. It has to happen at some point, okay? It can't continue on forever like this. People will just get bored. So one day it's going to break out here. It might be long, might be short, nobody knows. That's the fun thing, right? But the key is when the price breaks above or breaks below, that's it. You're in a short market now, or long market, whatever the price does. Okay, so that's a little thing about which direction to trade in. The basic key is to have a look at the trend on a higher time frame. If I'm trading daily charts, I look for a direction using the weekly and monthly charts. Look at the overall trend, intermediate trend, and then on the daily charts, or the chart that you're trading on the time frame, looking at the current trend. If all indications on the overall and intermediate trend on the weekly and monthly chart are looking long, but the current daily trend is short. To me, that states that the market is counter trending, which sounds like a great opportunity for a reversal. Do your technical analysis and keep your eye out for reversals on the important key levels determined by your analysis. So basically what that is, if your weekly chart is long, your daily chart is long, and then your hourly chart is short, what you want to do is you're waiting for that short term move down. Because we're only looking for buy moves, we want the market to come back down, looking for the key areas. Okay, never hit that. You can base it on there, you know, support, resistance, looking for all these levels, and then when you get that little signal of a trend line break, you buy. You feel confident because you know the daily and the weekly charts are long. You've just bought at a lower price, you know, price is going to go up. That's the high probable thing to do. Okay, so there's a few things out there for you to choose which direction to trade in, but it's very key that before you start trading on every single currency, you know which direction you're going to be trading in. Okay, don't chop and change. Don't say I'm long, but then you get a dark cloud cover, and then all of a sudden I'm going to go short this market now. Stick to your plan. One thing I do is, because I'm looking at the trends on higher time frames, I can't always, you know, decide for myself or remind myself without having bits of scraps of paper on my desk, inside my phone, inside my wallet and stuff like that. Man, scrap bits of paper just lying everywhere. I like to color coordinate my charts via the templates. I have trader longs, which is signified by my foreground as being green, and then I have my trader short, which is signified by the foreground being red. It's very easy to set up. You just go to your properties, foreground, just change that to whatever colour you want. Let's just change it to yellow for a range market. Okay, and then just go back to the template, save the template, and then we'll put in trader range. Okay, now that's a trader range market. And then I go to my lower time frame, which will be trading off, and that way I can look at my charts, wait for the setups without going back to the higher time frame, and just remind myself which direction am I trading in. Because if you've got 6 currencies, long, short, short, range, long, short, you know, doesn't matter, you're going to get confused. So an easy visual way to do it is to color code the chart foreground. Okay, so template, long, easy, look at that, go back to your hourly time frame, you know you're long, you know you're in a range market, start drawing up your support and resistance lines and trade between the range. Long markets, wait for price to come down, wait until you're in oversold conditions, wait for a trend line break and then buy. Short markets on a weekly, go to your hourly time frame, price is coming up, brilliant, we wanted to do that on a short market, right? So short market, start drawing in your trend lines, support and resistance levels for this, signified by this high, this low. These are all probable areas. Put in your Fibonacci's, draw it from this high to this low. Now look at that. That's a great opportunity for a reversal, because we've got a little bit of a confluence here from that resistance level that I drew in from this little high there, and the 23.6% Fibonacci. Now, price come up here, hopefully throw up a little doji or draw a little engulfing bearish with the oversold stochastic, and then that's it. Bang, be in a trade, you know. Place a stop loss 5 to 10 pips above the resistance level there, and then just wait for the price to come back down, as long as the profit to risk ratio is correct. So you'd probably be risking 20 pips, gaining 50. That sounds all good. So you know, these little events happen all the time. It's just down to yourself to find out what you feel comfortable with, what fits your trading style. How long have you got to sit at the charts? Which time frame are you trading on? Which time frames to look at? You know, it might be monthly charts, might be weeklies, might be dailies. You might be trading off the 5-minute time frame. If you're trading off the 5-minute time frame, look at the 1 hour and 4 hour charts. You know, find out where the trend is. You know that trend line got broken, so you're in a long market now. So go back to your 5-minute chart and only trade long. Okay. So, but it is very important to know which direction you're going to trade in. And one thing I'll do for you is I'll put a couple of templates up at the bottom of this page, just like this, just very simple ones, with the color coordinations on them. I'll probably change this to a white, and then there'll be a green and a red one. You can change it as you want, just need to copy them into the right folders, which I'll leave a little video of how to do that as well. And you know, start utilising that in your trading. Put the indicators that feel right to you. So if you want a MACD on there, bang a MACD on. Keep your color coordination. Save your templates. Go to template. Save your templates. You know, save it as whatever name you want. You know, it's yours to keep. But it's only a template. You know, I'm not going to try and sell it to you, but it just helps your trading so much. Okay, so I hope you have clear direction in where you want to take this. But thanks for watching, and I'll see you in the next videos. Thank you.